On the call this morning, global markets sell off with top EU officials failing to agree on a Greek debt solution. U.S. futures are down 0.5% as a Goldman Sachs report cut second quarter annualized U.S. growth to 2% from 3%. And crude is down 2%, erasing gains for 2011 and approaching bear market territory on a declining economic outlook. I'm Alex Steele, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Alex Steele with The Street, and together we bring you the morning call. Scott, happy Monday. We have a lot to cover today. So stocks ending mixed on Friday. Futures are pointing down this morning as, of course, EU ministers put off green lighting that next aid chunk to Greece, which they need by mid-July, waiting on those austerity measures. Doesn't look good right now. I also read an article this morning that said the charts are pointing to a deep double-dip recession. Is that what you're seeing?
Right now we're at a very crucial area. I feel like for the past 2 weeks, all we've been talking about is how the indices are going to get to the 200-day moving average, how you have to be very prudent, you have to be patient because the technical indicators are pointing lower. And then I feel like every day also I turn my iPhone on, not my BlackBerry, and you're always seeing something with Greece. They're going to do it. They're not going to do it. I think we're on like Greece fatigue. But the bottom line is they have a lot of problems over there, and if they don't solve those problems, they're talking Spain, they're talking Ireland, they're talking Portugal. It's just, it sounds a little bit like that Lehman, the whole scenario.
But what about the fact that on Friday the S&P closed at 1271, and then last year when Greece got their first bailout package, they was at 1200. I mean, isn't that a relatively positive sign that we're still holding up relatively well comparatively to last year?
Well, on a macro basis, we are. If you think about where we are in the indices, the S&P is down 7% off the highs or so. We've up 30% from September of last year. We're up 100% from the 2009 lows. But when you're going through a corrective pattern or phase, it's still painful because everyone has different entries and exits. And that's what we're trying to teach everyone, how to enter and exit the market. And we've seen some signs to exit the market. We've tried to show you support areas to get out, stop yourself out, maybe even get short. And now we're getting to those areas that could be worth a look for a tier one. But I wrote the title of my article today was For All the Marbles. So that means we have this spot right here. So let me take a quick look. Let's talk up this.
I'm thinking like for all the crazy people, for all the balls in the air. I can't tell which one. Yeah, but let's take a look at the chart to see what will happen if we do hit that 1250 level and where you'd be buying.
Okay, so right here on the S&P, just real quickly, those signs. This is when we killed Osama bin Laden. This was the high of the market. It told us something. This was that breakout failure, potent and bearish engulfing day when IBD put us back in a correction, a time to sell some. Now this is interesting. If you followed those rules, here's a 200-day, here's that Japanese crisis low. We have to see how we hold this 1258 to 1250 area. If this area holds, and it seems like they're trying to hold this area, this could be very similar to last year when we had 1040 to 1060, which was that 4-month support area that the market held until they dealt with a lot of those headlines, and then you saw in the third, fourth quarter, there was a rally. But it was important to hold then, and it's very important for us to hold here now.
And if we don't, what are we looking at, the 1180 level here?
Well, first is about 1220 to 1225. That's a new point of reference. And I do think that 1170, 1180, if volatility picks up, if some more headlines get extreme, if something out of the ordinary that no one's expecting happens, that is another big area. But first, we have to deal with this 1250 zone.
And then I want to hit on tech. Obviously had a bad day on Friday, led down by RIM, of course. But is that just a RIM specific leading the sector down, or is that sector also not holding up well?
That sector's been being sold first. A lot of people went out short last week, and then we gapped up on the futures. I believe that was on Wednesday, and tech just went negative first. Apple starting to break down. We'll get into that. Tech is below the 200-day. If you take a quick look at the Qs, they're already through that 200-day, and they're at the Japanese crisis low. So right now, that means that tech, which is the innovation, which is the growth, is weaker. That's a bad sign for the markets. It's something you have to take notice to.
And then real quick, what about the Russell?
Russell is sort of like tech, where it went to the 200-day moving average first. It held there. You got a small little bounce, but now it seems though it could break below. So we need to watch to see if those lower pivots in the Qs, which is tech, and the Russell break, because then S&Ps could follow right with it.
Break below will be the theme.